morning, gang. Welcome back to Market Talk Mondays, when we're doing it actually on a Tuesday today.
I had a busy day yesterday.
Yeah, and the bond market was closed yesterday. Happy belated Columbus Day
Yep.
or Indigenous Person Day.
The markets were open yesterday, though.
Yeah, the market was open. Yeah, the equities market, and there was a little bit of excitement on the come, where we got a little bit back yesterday off of Friday's real exciting
that
move.
was our first significant pullback we had seen in quite a while.
Yeah. So you had some conversations with clients in a specific portfolio.
Specific model.
Let's talk about that a little bit and kind of what the mentality was with those changes that you made.
Yeah, so the basis behind my recommendation of and doing the big muscle move of taking some of our clients that had exposure to our unconstrained model on their qualified accounts. My position behind that was I'd seen over the course of time, any time that there's any trade uncertainty, especially with China and the amount of rare earths that come out of China, the NASDAQ gets hammered every time. And just coming up to the end of the year, fourth quarter, year to date, NASDAQ, I mean, the unconstrained was up 72% for the year.
It's a big move compared to the S&P being where?
S&P was at the time, about 15% year to date.
Yeah.
So, and the unconstrained tracks predominantly NASDAQ. It's NASDAQ heavy. NASDAQ was up about 17% before Friday.
For the year.
Yeah.
So still a multiplier on that. That's pretty amazing.
Yes, absolutely. And some of our clients have been in it since July or June. So they've seen about 35% of that 72. So I, as the advisor, wanted to make sure that, hey, before this gets a little crazy and we start seeing more rhetoric between Trump and China and Xi and whatever they're planning, because it's not if, it's when, the market corrects even more. I wanted to just kind of lock in where I could lock it in without having huge tax implications on the client. So trade those
So
accounts.
mainly you did this in qualified accounts or IRAs, 401ks.
Absolutely.
So that there would not be a big tax hit to realizing a big gain.
Yeah, if you realize,
portfolio.
yeah, on some of these positions, if you realize a 35% gain, that could be a pretty big tax burden.
So typically the trade would be, and I don't want to put words in your mouth, but the trade would be a little more kind of like when you dollar cost average is a defensive position.
Yep.
A defensive position of leaving a trade would be the reverse of dollar cost average, which is selling off a little bit of the portfolio each time versus taking just an immediate.
Yeah, that's typically what we would do is dollar cost average back out.
Yeah.
But where my headspace was at and the uncertainty of the trade, and if Trump even goes and meets with, I'm blanking on the South Korean, their president or their prime minister, and Xi talking about, I might not even go meet with them, kind of puts a sentiment in the market that there's really not going to be any talks of any trade between U.S. and China, or if there is, it's going to be highly tariffed.
So specifically, you're talking about the Asia Pacific investment forum, economic forum.
Yep.
Yeah.
So and that's why I made that move. I really just wanted to see where we're at with tariffs, because if Trump does put hefty tariffs on China, I think that leaves a lasting mark on the tech sector, specifically the NASDAQ.
Yeah.
I think that could drive a little bit and be the start of a little bit of a pullback. And we saw some of it Friday. Monday, we saw it have its biggest day, I think, since May or August, I think.
Yeah, with a rebound.
Yeah, so you kind of saw a dead cat bounce, is what we like to call it. But with that said, I didn't take, for some clients, if their risk tolerance was high, and the clients know who they are if I'm talking about it, but I left you in some more conservative models instead of going straight to a money market fund. And then on Monday, some clients, again, that had a little bit higher of a risk appetite, I dollar cost average back into the market on a more conservative front, specifically in an inflation model of ours that has a little bit more exposure to commodities. Because I think as we see a little bit more of a pullback, I think we'll see it kind of reflect in commodities You see gold's hit all-time highs.
Yeah.
Still going.
Gold's over 4,100 now. We're over 4,000. I think this morning it was at 4,135. And so, gold, silver, commodities is historically, it is a precursor to the unsettling of currency fears and fear of a dollar, or fear of a country's sovereign currency going down in value.
Yep. And that's where kind of my headspace at too is, okay, Trump does retaliatory tariffs against China for certain measures he wants to take. A retaliatory-esque measure China can take is they're significant holders of U.S. debt. So what you could see is China trying to put pressure on the U.S. with selling our debt.
Yeah.
So that's another thing that I think that could affect the market a little bit moving forward is China's like, okay, you're going to, excuse my French, but tariff the crap out of us.
Yeah.
Here's in turn, I'm going to mess up your economy a little bit, and I'm going to sell off large numbers of your debt.
Yeah.
So I could see that kind of playing out. I'm not saying it's going to happen, but I'm saying it could very well happen as a retaliatory. If I was China and I was Xi and someone's tariffing me and putting pressure on me, that's the kind of things I would do to put pressure back on them. Okay, you're going to do this, but I'm going to do this over here, and then kind of force the hand to go talk. Okay, hey, settle down, selling my debt.
Yeah. Well, switching gears a little bit as we kind of step back into this macro world and seeing what's going on. Here at home, still a government shutdown.
Yep.
The government, specifically our Congress, is still, holding the American people hostage financially through not creating a balanced budget, through not creating a plan moving forward on how to reduce America's spending habits, specifically how the federal government spends our money. So what that leads to is in the FOMC, or the Fed's Open Market Committee, it looks like they're still leaning towards cutting rates end of the year.
Yep, absolutely. They're looking at cutting rates. They're saying right now, there was a report yesterday, major employers, you're seeing a low hire. This happened yesterday. You're seeing a low hire but low fire. So not very many new jobs being created, but you haven't seen quite as many people getting laid off yet.
Yeah.
I think once we start seeing more and more people getting laid off, you can see the Fed again start to ease the money supply a little bit.
They have to.
It have to when that happens. Exactly.
Yeah.
They have to stimulate the economy somehow.
Yeah.
And that can happen in one or two ways. They can either do devaluation of currency, which is print more money, or what they can do is raise income tax. So it's very, and I've said this multiple times, sound like a broken record, it's very eerie to me how correlated in the same actions that we're taking in the late 2020s to the 1920s, the government is taking sort of similar actions. And we're seeing a technological boom with AI. They saw a technological boom with the Industrial Revolution and cars and automobiles and all these plants being made. You saw the NASDAQ go from $31 to $384 by 1929. Then October, you saw a big hit. And people were trading on margin back then. A lot of people now are trading on margin. And everything is so leveraged. There comes a point where you get so leveraged, there's a breaking point. And when you have that breaking point, it caused the government to go into the private sector, go to this private sector, put more money into it. And if it's still losing, then they have to go to the Treasury, and the Treasury now has to buy out the government. And it's like, where does this money go? Where does this debt go? Because now you have all this leverage over here, and then you're devaluing money over here because now the Treasury's like, oh, I guess I got to print more money.
Yeah.
And put more money in circulation.
Well, you were making a correlation earlier, and I just want to be clear. Did you mean the Dow went from 31 to 381? Okay, I heard you say the NASDAQ, and I was like, wait a minute, we're going to confuse people.
No. The Dow Industrial, the NASDAQ was not a thing yet in the 1920s.
Right. So the Dow moved significantly higher during that 10-year period. The Roaring 20s.
The Roaring 20s. And the reason it moved so much as there was a sentiment of greed amongst the U.S. That people were fearful of missing out on big market moves.
So are you saying we're in the roaring 20s again?
We're in the I wholeheartedly believe we're in the roaring 20s again.
Yeah.
But instead of automobiles and plants and steel manufacturers and all these and skyscrapers being built, instead of that, we're seeing it through AI.
In tech, yeah.
Mm-hmm.
Interesting. Well, more to come on that, folks.
Yeah.
All the more reason that when we have these conversations and we bring market commentary to you by Isaiah and the team at Foundations Investment Advisors, all the more reason to be diversified. All the more reason to take an approach that the equities market in and of itself can't be your silver bullet.
Yep.
You have to have actuarial science with investments.
Mm-hmm.
You have to bring together the income products that provide safety, security, guarantees, along with those hedges against inflation,
Yep.
which is typically why we even use equities, is to, number one, provide a future hedge against inflation.
Mm-hmm.
And then outside of that is to have wealth, to see your wealth grow, and to create not only an asset for yourself, but if you have a family, if you have children, if you have philanthropic desires, having that growth is going to be super important to you. But it has to be managed.
It does. It does have to be managed. And I'm going to send it out with this email that goes out for the market commentary. It's a good white paper. I think it was written by Tom Hegna about bond markets and fixed index annuities. I know everyone's going to scream hearing the investment advisor talking about fixed index annuities, but bonds in and of itself can lose their principal value. They also they have market risk as well. It's not a silver bullet to go to where your principal value is going to be safe. That's just simply not how it works. There's only one place you can go, in my mind's eye, that's going to keep your principal value safe, and that's fixed index annuities.
Yeah.
And using that in correlation with the market. So when the market takes a 37% hit, you can go over to this side of your portfolio, and you can see that if nothing's happening in it at all, you have a floor and that money's safe. Bonds, you could see an interest rate hike, and bonds just get crushed.
Yeah. The premium is now sold at a discount.
Mm-hmm. I mean, Ray Dalio back in the 70s called for it. That he was like, hey, the bond market's going to get crushed, blah, 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 blah. And you can read that in his book, Principles. There's a plug for you, Ray. But
Great book, by the way.
He called it back in the 70s, and he was wrong. Bond market actually erupted. And it almost lost him his job. But that being said, it can go either way. And bond markets, it's not just the safety of principal. You can lose, like Ray said, you can lose your value in bonds. And you can lose your skirt, too.
So it makes sense, again, the old message that's still the new message, diversification.
Yep.
We have to be well diversified.
Not just in equities, but it's asset location. Where are your dollars actually being held?
Yeah. All right. Love it. Hey, thank you guys for staying tuned. There'll be more of this next week.
Yep.
And as always, we appreciate you, Isaiah. Thanks.
Yep, no problem.
Foundations, thanks for keeping things in line for our equities clients. All right. Have a great day. We'll see you soon. Love you guys.